Are you struggling to wrap your mind around your financial life? Keys to the Coin with Dr. Paul Etienne is the podcast you need. We'll help you gain confidence in every coin through engaging discussions and financial know-how. Improve your financial literacy, become independent and debt-free, and learn more about the opportunities around you. From stock market investments to real estate and retirement funds, the possibilities are endless. Visit madbu.com and download our app, MadBoo Max, on both Android and iPhone's app stores.
Welcome to Keys to the Coin. Today is the start of the second season of Keys to the Coin. It has been a while since we last spoke, but I'm happy to bring you a second season where today we will talk about a lot of things today. But for the season, we will have a lot of wonderful guests, guys. I cannot wait for you to listen and watch some of the other episodes that we've already recorded. There's a wealth of information that we will bring you in that second season. So I'm hoping that you guys will enjoy this season and every single episode, and that you will share with your friends or your family and anybody you think might be able to benefit from the information that we will discuss and provide in the second season. And also, if you listen to something or if you learn something, don't just learn it, apply it to your life, apply it to your financial life, your personal life, and become a better version of yourself. This is the last day of 2021. Brand new year is just hours away. So be ready for the new year, have a plan for the new year, and make sure that you are a better person in 2022 that you were in 2021. How you're going to become that person is by learning, by being aware of what you are right now and the things that you don't want to bring into 2022, and make active changes to those things and better your life. So today episode, before we start with today's episode, it's been a while since we last spoke. Like I said earlier, it's because I was in my last year, pretty much, in my doctoral program in finance. So I had to finish my dissertation. It took a lot of time between work, family, and other projects we had. So I had to slow down on the podcast to take care of that. But now that's over. We're done with school, completely done. And so I have more time now to dedicate to this podcast, to dedicate to you guys, and to bring a lot of new information to you. And hopefully you guys enjoy that. So today's episode, we're going to talk about stock trading. Going with the basics of it, because I know I've received a lot of questions from you guys about, how to trade stocks or how to get started, or what it is in general. So we're just going to touch base on some of the basic information on what stock trading is and how you can get started. First of all, guys, let's start with the information I'm going to go over today is just for informational purposes. So stock trading can be very risky. Do your own research, and everything that you see online, don't just go and put all your money in a stock or trading. Do some research. If you have a financial advisor, talk to one. If you don't, look for one. Most of them do not charge for a consultation. So keep that in mind with that information that I will give you today. So in the stock market it's a really huge market. There's a lot of things that you can do. There's a lot of money that you can win. A lot of people become millionaires, billionaires trading the stocks market. But a lot of people also lose account. They blow their account doing that, because if you're not doing it the right way, just like there's potential to grow, there's also potential to lose a lot of your initial investment. So we want to start with the most basic part of it, as far as some of the terms that you guys should know or should be familiar with, because that's the things you'll hear the most in the stocks market. So you have to know what those things mean in order for you to be active in the stock market. Now, stocks market, there are a lot of companies out there, but not every company is publicly traded. Some companies are just private or privately owned. So you can't buy stocks, you can't buy a percentage of that company because it's not available to be purchased. Others are publicly traded, and they do that by doing what they call an IPO, an initial public offering, which is something you probably have been familiarized with recently, since there's a lot of major companies, or what they call the unicorns, or newer companies that have pursued or that have started an IPO in 2020 or 2021, that include Uber, Lyft, Robinhood, Rivian. Like, a lot of companies have done an IPO. So that's when the company get someone to do a valuation of the company and say, here's how much the company is worth, and here's how many stocks we will issue, and here's how much each stocks is worth. And they list that company in the stock market. There's different stock markets that you can list it on. And then people like us or commercial traders will purchase those stocks, and each stock is a percentage of the company. So you may own a small percentage of that company when you own a stock. So that's done through an initial public offering or an IPO. So it's some terms to be familiar with. So when you trade your stocks, you have to know what the company is, or what the company does. You have to be able to analyze the company before you buy the stock, or because when you buy the stock, you literally become an investor in that company, like an owner, because you own a share of that company. So that gives you the right, to vote in some instances in decisions of the company. So you have to buy a company that or a company that is doing something right, or something that's gonna help bring the price of the stock up, because the whole purpose is for you to make some money, right? So you don't want to just buy stocks just because everybody's buying stocks. So you have to be familiar with what an annual report is and how to pull that report, so you can see how well the company has performed in the past year. So the more you know about the company, the better, or the more comfortable you will feel when you invest in that company. And there's something called arbitrage in trading. This is where buying or selling a security, maybe the ask and the bid price may be different from one exchange to another exchange. So there are people that actually make a living buying the difference. So if we can buy a stock for $165 on Robinhood, but on Fidelity it's $166, that's a $1 difference that someone can take advantage of. If somebody buys 100 shares, that's $100 difference that they can make. So that's called arbitrage, where people use the difference in price between one brokerage to another brokerage to actually make a living. And you have different markets. You're going to have what they call a bear market, and you're going to have what they call a bull market. Bull, it's what they call, it's when you are positive, pretty much when you expect the market to go up, or when the market is going up. The bear market is when the market is going down. So right now we're pretty much in the bull market, and most of the time it's usually the common knowledge is it's 7 years of bull market, and then 3 years of bear market. So you can make money in either markets, because what's going to happen is if you're positive, you buy and you wait for it to go up. If you're not so positive, you sell, or you sell, whatever you have, or you can put options on, or more. But that's for another discussion. We'll talk about options in this season. There's an episode with Asel where we talk about options trading. So you guys will learn more in that episode when it airs, sometimes in January. Now you have what you call the blue chip stocks. Okay, so those are some stocks you want to have in your portfolio. You don't want to have just any type of stocks in your portfolio. So the blue stocks market, the blue chip stocks are some of the stable stocks that have performed really well in the past and that have paid significant dividends. Dividends also, that's some term you should know. That's when a company pays you just for owning their stocks. Usually they pay on a quarterly basis. So if the dividends, it's usually a percentage. But for example, let's say it's a $10 stock and they pay 10% dividend. It's usually not that high, but just to make the math simple, that would be $1 per year. So you'd get 25 cents every quarter. So you get $1 per year. So if you have, it may sound like it's small, not worth it, but if you have 100 stocks, now you're making $100 per year just for owning the stocks, and you still own your 100 stocks. If you own 1,000 stocks, that's $1,000 per year, just money for owning that stocks. And then you can do what they call reinvest the dividend. So whatever you earn, you buy some more stocks. So you're buying some more income, to the point where if you get to a point where you have enough, you can actually use that as a true source of income to live on. That's cash flow pretty much. And you have what we call a broker. A broker is what we would call it's a person that sells an investment or buys it in an exchange for a fee or like a commission. Now we have a lot of brokerages out there that are not charging a fee per transaction. I think Robinhood has been the company that has helped a lot of brokers to get on the same path, of not charging people for a fee. But usually you used to pay every time you place a trade. You used to pay for a fee to actually place that trade. And some companies still charge the fee, but there's too many companies out there that do not charge a fee, where if you want to pay a fee, it's really your business at this point, because there are options out there. So if you have my app, which is MadBoot Max, you can go in the resource section. There should be a link to a few different brokerages that do not charge a fee. You can create an account with them and start trading and actually get a free few stocks just for signing up with them. So there's resources there if you don't already have a brokerage that you can go to. So another term to be familiar with is day trading. Day trading is amazing. It's also completely risky. I don't recommend just anybody to start day trading unless you've been trading for a while, you know the market, you have the knowledge, you have the experience. You can make good money, but you can lose a lot of money. It can be very stressful, especially if you don't know what you're doing, especially if you're not doing the technical analysis. So you know what to look for in a company or in a chart. You need to know what kind of indicators to add in a chart to analyze it. When you see this and meet this requirements, you have to buy, you have to sell, you have to stay out of the market. You have to know those things before you start day trading. So if you see people leaving their jobs because they are day trading and making money in the market, do not just leave your job to do the same thing. You have to have the knowledge. So do some research first, take some classes if you have to do so, get a mentor if you have to do so, because there are a lot of people out there providing a lot of resources, a lot of teachings. So before you leave your job to do day trading, do your research first. We talked about dividends already. So make sure that if in your portfolio is like, let's say your wallet, and then all the cards you have in your wallet, that would be your portfolio of cards. So your portfolio would be your account or your holdings and all the things that you have in your account would be part of your portfolio, like all the stocks that you own, all the ETFs, everything that you have in your possession, in your holding would consider what they call the portfolio. Another term I want you to be familiar with is a haircut. So a haircut, that's why you have to know the market and the terms, because if we're talking about barbershop, you talk about a haircut, I'm gonna go get a haircut, So when we're talking about the haircut in the stocks market, we're talking about what we call a spread. A spread is the difference between the ask price and the bid price. So it's how much I want to sell a stock for versus how much somebody want to buy a stocks for. So that's usually a difference in cents. Sometimes it can be a difference in dollars, depending on how big the stocks is or how liquidity is in the stocks. Because if the stock is not very liquid, if there's not too many people selling or buying it, the spread can get big. So a haircut is when the spread is really thin, and that usually happens when there's a lot of liquidity in the market. So when the spread is really thin, that's what they call a haircut in the market. And then you have indexes. Index is wonderful. So that's something you can do if you don't have a lot of experience. When they talk about index funds, it's a fund that's based on the performance of a market or a group of stocks. What that is it's less work for you. If you don't know how to analyze a market, an index does that for you. They take the best stocks in a specific, based on specific characteristics. Could be based on a specific performance base, or could be in a specific industry. So your index means you are trading and getting rewards based on how well that index is working. One of the most famous one is the S&P 500. That's the Standard & Poor's 500. That's what they call the S&P 500, or the Dow Jones Industrial Average. So look into index funds, and if stocks sounds too complicated for you, you can get into indexes to trade with indexes. Because what happens is an index takes the best 500 or the best 100 companies, and they put them in a basket. So you buy a basket. When you buy that basket, you buy a percentage of each one of these companies. So it's kind of like a hedge, which means if one goes down, chances are another one will go up. So that always averages itself out, where you can most likely get a profit, because you're not just dealing with one stock. If it goes down, you're in the hole. If it goes up, yes, good. But we know whatever goes up can go down. But if you have like 500 companies and the index chooses, some of the best ones, chances are you're gonna be in the green, at the end of the day, because some of them will be performing well, even if some may not, but you'll be most likely in the green. So the average, you can easily average 10-15% per year, which is really good if you're not doing anything, or comparing to putting your money in a savings account. So margin, that's another thing to know, and that's another thing to stay away from. Stay away from margin if you do not have the experience or know how it works. Margin is pretty much the brokerage giving you a loan for you to trade based on how much money you have in the account. They let you control a certain amount of money that you can use to trade. It's wonderful to make money. Leverage works in every industry. You use leverage to make more money, like real estate. When you get a mortgage, you are leveraging the bank's money. You put $20,000 in front of the bank, and the bank say, okay, because you do that, I will let you control $80,000. So you can in total buy $100,000 worth of real estate just for putting $20,000 down. So you are leveraging the bank's money to buy a mortgage, which can be fine, the same as it can be fine in trading also, but you have to know what you're doing. Because if you borrow $100,000 to trade and you not trading well, or you're trading the wrong things and that starts going down, now you owe them some money. You're going to get that margin call. And when you get that margin call, man, we'll talk about that if you ever get one, but don't try not to ever get one. So until you're really ready to start trading with margin, stay away from margin until you get that knowledge and have the experience to be trading in the stocks market. So another thing is what we call the pink sheet stocks. Pink sheet stocks, unlike the blue chip stocks, is what we call penny stocks. Penny stocks. I used to believe penny stocks were like, stocks that are like cents, but it's not. Any stock that's under $5 is considered a penny stock. So there's a lot of room to grow, which means you can make a lot of money with penny stocks. You can take stocks from like 10 cents to like $2 to $3. Of course, after you do your analysis and you see what the company is about. But at the same time, they are penny stocks for a reason. Usually there's not too much value with that stock. So you can buy it. It may be just pennies, but if it goes down, you're going to lose a lot of pennies. And if you buy thousands or millions of those stocks, things do add up. So keep in mind, whenever you're trading stocks or penny stocks, it's just like regular stocks. You have to still do your analysis. Don't look like, oh, it's just a few pennies. I mean, if you're spending $1, fine. But if you're going to buy a lot of stocks, you have to make sure that that company you want to go up or you want to win with is actually worth it, or actually has the potential to grow, or actually has the projects that will help it grow, the innovation that will help it grow, the support, the backing of some major projects, so some major programs or some major investors. So that's an easy way to find out too, like who are investing in those companies. And that applies for everything, not just the pink sheet stocks. Who is investing in those companies? There are a lot of resources out there where you can see who's investing in what, which company is investing in which company, which CEOs is investing in their company, how much stocks they're buying, which government officials, are buying that stocks, or how much of it are they buying, at what time they're buying it. So those are like cheat sheets that are actually available to you, where you can use that type of information to make a decision about which stocks you want to buy. But to me, technical analysis beat all of that. And if I'm just saying that term, there's two main ways to analyze or to trade. You have what they call technical analysis, and you have what they call fundamental analysis or fundamental announcements. So a technical analysis, for example, is when you see, hey, the stock did this, the stock did this, last time the stock did this happened, went up. Last time it did that, it went down. Or when this thing matches this thing and this thing, chances are the stock's going to go up. So you use those things to analyze the market with the charts, with those indicators, to decide if the market will go up or down. But that's the preferred method, because that's something that you can do in multiple markets, right? And then you have the other, what we call the fundamental trading, which not fundamental, but fundamental analysis, trading, which is where you trade based on events. And one of the prime example is the non-farm payroll, which is every first Friday of the month, when the government comes out with the numbers of jobs that were created that were non-farm related, and then that will trigger the market. If the response is positive, people will be positive in the market. Will be okay. The market is supposed to go up because there's a lot of more jobs created, so everybody will start buying. And that also applies to the foreign exchange market, which is the forex. So the US dollar in that case will go up against all other pairs because there's some good news for the US. So the same applies for the company. If a company will come out with their annual report or with their quarterly report and they did really well, that's considered a fundamental event, because there are some major information now that may override whatever technical analysis that you've done. Or if there's, I hate using that type of example, but if there's an attack, on US soils, or against the US. So people start being bearish on the US economy because, some bad things are happening. So stocks market will go down, or the US dollar will go down. Or if the US is doing some good things like finding a vaccine for the coronavirus that's going to help people get out, that's some good news. So people are more bullish now because they start buying because they believe the market will go up. So I believe in technical analysis. I think you should always do your technical analysis, but also be aware of fundamental events when they're going to happen, because they may override your technical analysis and determine how the market will react. So you have the sectors also. The sectors is, you have the industrial, you have your marketing firms, or not marketing firms, but you have your IT and you have your real estate. You have stocks in different industry and categories. So you can invest based on the specific categories. If you're big on real estate, but you can't buy a house to invest, you can buy companies or stocks from companies that are in the real estate sector. So if you also don't or have the app, if you don't have it, download it. If you already have it, there's a section that says sectors. If you click on there, you'll see some of the best stocks on each sector, and you can analyze them from the app. You can see all the details about that stock, really, to help you do your technical analysis and see which companies are in which sectors and how strong is the sector before you decide to trade, because there will be some indexes that are specific to a sector, from a real estate standpoint, or from an IT standpoint, or from a services standpoint. You get the idea. So the stock symbol will be what represent the stock when it's listed in the market. So for Apple, it's AAPL. For AT&T, it's just T. For Verizon, it's just V. So that represents the stock. That's a stock ticker or the stock symbol. So you have to know those things when some companies or some people are referring to a stock, they will just put the symbol of the stock. Or if you're looking to buy the stock, you have to know the symbol of it. Like, I think Robinhood is just Hood, HOOD. So those things you have to be familiar with and understand how they work. So those are some of, and the last thing I want to touch is what we call it's volatility. So it's good when there's volatility in the market, but also it's bad. You can make money and you can make a lot of money and you can lose a lot of money, because it's like it's unstable. Market's going up and down, up and down. If you fast and you experience, you can quickly cash out on when it goes going up, or you sell it when it's going down. It's good when there's movement, but it's bad if you don't know what you're doing. So that's why the best way to make money in stocks market is to do long-term investment. Instead of looking at what you can make today, look at how well will this company perform between today and December 31st of 2022. Like, what projects this company has that will make it a great contender between now and December of 2022 or December of 2023 or 2024. You can or should hold some stocks for like 5+ years. That's when you will make the true money, or that's when you will get to see true growth and true performance in those stocks. So if you want to do day trading, nobody can stop you, but do your research. But myself, I recommend, I would suggest that if you want to get into stocks, first, do a lot of research. Second, do consider some index funds, as they are really easygoing, easy to manage. And then do long term, That way, you're not stressing every day about what is this stock doing? Should I sell now? Should I buy now? No, just buy it and because one of the things that affect people the most when they trading is the emotional part of it. If you get your emotion takes the best out of you, you're gonna lose. There's no way about it, because you're gonna start panicking, and once you start panicking, your decision is gonna be clouded. Okay, so get a mentor, do some research, use my app, Madbo Max. There's a lot of information you can find about stocks, and also track your expenses and stay on top of your budget. Or, download other apps or go on YouTube, watch other videos, learn more about trading before you start trading. But at least start with this basic information that I just gave you today. Learn more about the market. If you have questions, feel free to ask me on YouTube, on IG, on Twitter. Let me know. So that's everything that I wanted to cover for you today, guys. I hope you've enjoyed this episode. We have a lot more episodes coming up soon, and I can't wait for you guys to see more. If you have more questions, let us know. Thank you again for watching today. Thank you again for listening today, guys.
That's a wrap for this episode, and we're excited for more. Thank you for checking out Keys to the Coin with Dr. Paul ATN. Stay connected via madboo.com and on Instagram, Twitter, and Facebook with the username madboocom as we continue to unravel the financial world with tips, insights, know-how, and more. Download our app, Madbo Max, for insights, news, free stocks, and financial tools. As always, we hope you learned something useful from this episode. On your way to creating your financial path, live a productive, debt-free life, and ultimately gain confidence in every coin.